Midstream is an area that a lot of people are talking about. There's a massive capital need. And let's focus on some areas to access that. But as we're thinking about it, one of the things that we're trying to identify is what creates this opportunity in the U.S. Why is this U.S. pipeline there and it wasn't there 3 to 5 years ago? What's the risk profile of these investments? Where are the opportunities, depending on where you want to play across the value chain? And what's the global impact? But I think, I want to just talk about a couple ways to play it, but I want to leave you with the idea that there's plenty of ways to play it depending on your risk profile, and there's a lot of capital needed. I think there's an orientation in the U.S. that if an energy opportunity makes its way out of Texas, where there's plenty of money and plenty of entrepreneurs, you got to be very wary, buyer beware. I don't think that's the case anymore. I think there's a lot more capital needed than they've ever faced before, and these hydrocarbon areas and these basins have expanded beyond Texas into all parts of the U.S. and Canada, and we'll highlight some of the things and the opportunities for non-U.S. capital to come in and play in a very important role. So one of the most important things about how this has come about is the history of hydrocarbon production in the U.S. The U.S. has played an important role going back a century, and there's a lot of good data on where the hydrocarbons actually exist. So these techniques and these technologies for resource recovery, enhancing the recovery from 10% to 20%, it's a very rapid initial production using these techniques and a very rapid decline, but after that a very flat production profile for 20 to 25 years. And I think that sets up for very stable long-term investing profiles. But the fact that the data is already there in a lot of these producing areas gives a real advantage versus some of the other areas that have these shales, but maybe don't have the history of hydrocarbon exploration production. Massive opportunity, $640 billion. I'll try to decompose that into areas that are accessible today. And it also, at the same time, highlight that all risks in basins aren't created equal, and some traditional core infrastructure investments that seemed safe in the past have been unseated by the changing hydrocarbon economics from basin to basin. A lot of money has been raised for this space, almost $50 billion in the last couple of years. A lot of that's oriented towards production and energy services, which is the higher end risk of the spectrum. And also, there's a lot of ways to play core infrastructure. I think the best way is to work back from the demand orientation today to provide very good visibility on stable cash flows. So first, these are just things to keep in mind. Have you been looking to invest in U.S. energy? And you can kind of decide maybe after this presentation or quiz me afterwards whether that's something you want to pursue going forward. Just a quick map of the U.S. to orient your geography a little bit. You can see there's a lot of basins in the U.S. and the production has grown in an unconventional way around natural gas shale from 1% 15 years ago to almost 30% today, and we think 50% over the next couple decades. But as you can see, the basins are not just limited to Texas and Oklahoma, or Alaska's not on this map, or some areas of remote areas in Canada, but also in the northeast part of the U.S., where one of the most prolific shale plays exists today in the Marcellus and the nearby Utica. I think that presents some pretty interesting and challenging opportunities, because those aren't areas typically where you have a lot of industry, or at least haven't in the most recent history. So not only is the production and drilling a challenge, but also the midstream takeaway capability, bring it to markets, is a challenge. You've probably heard about Not in My Backyard, NIMBY. But there's a new phenomenon in the US and probably other parts of the world too, that's banana. Build absolutely nothing anywhere near anything. So with that in mind, let's look at some of the basins and how they stack up. This is a chart that reminds me of a couple of the other presentations I've seen today demonstrating rapid growth. In this case, it's hydrocarbon production, but it easily could apply to the growth in sovereign wealth funds under management that my colleague Patrick Thompson talked about earlier today, or some of the other presentations. You don't need to know all these names. You just have to know that there's a lot of opportunities to invest in the US. One thing I think you've probably seen in trend is, with more investing in the space and with more efficiency in the extraction of these hydrocarbons, the price of natural gas has declined significantly. So this is still reflecting the U.S. as a the price of natural gas as a North American commodity. So you see it, trend up to the mid-teens post-Katrina, where there's some infrastructure bottlenecks, and then dropping off to closer to $3 or $4, and that may be where it sits going forward. And you say, why are people still drilling? I know that upstream folks get money to just drill wells, but what are the real economics standing behind this? So if you flip to the next page, and as I'm describing it, there are certain types of gas that you produce that's dry gas. It's really just natural gas, and that's priced on the local price. You call it Henry Hub, it's the $3 to $4 an MMBTU or MCF. But the real story behind some of the basin economics in the US is the liquids that's also produced with the natural gas. So liquids are all kinds of ethanes and butanes and propanes and other components, natural gasoline, that prices off the world oil price. So this chart's really showing a drop in US imports as US thinks about energy independence. But then the price of oil has trended up to north of $100 a barrel. Those liquids price off that, and as a result, hydrocarbon economics have favored the wet gas drilling basins in the US and Canada, and the rigs and the money and the people have shifted to those areas, effectively making it hard on just pure dry gas production in the near term. And I'll cover some of the long-term implications in a minute. So here's something to keep in the back of your mind. As you think about the supply stack for natural gas, it's maybe $3 to $4 today. What do you think the global price in natural gas will be in the long term? There's a lot of places that produce natural gas. There's a lot of developing economies and long-term demand centers that have no hydrocarbons and are paying premium for natural gas. For example, in Japan, Korea, it might be $16 or $18 an MMBTU today. Where do you think this normalizes over time? What kinds of investments do you need to make in global infrastructure to achieve that? So, as we think about it on the next page, these kinds of things have massive implications. There's reduced US demand. LNG exports have huge opportunities in the US, taking the gas abroad. It's hard to site these long-term, long-life facilities. You need very long contracts associated with that. So, for example, an LNG train, which is one of the units to export facilities to liquefy the natural gas and send it abroad, just the train itself might be a $5 billion investment. But in order to underwrite the economics of that in traditional long-term fashion, you might require a $40 billion contract to do that. So you have to think how many sources of demand can afford and are creditworthy to write a $40 billion contract. So again, with that in mind, you might say there's not a lot of LNG export terminals that will ultimately be built. Multiple countries can access shale, but you see some recent announcements from China. They've tried some shale extraction. It's not that interesting. They haven't been able to get the same success. Again, it goes back to, I think, the data and the history, but they might not be so prolific, or at least not where the cost is today. So again, let's keep that in mind as we think about the opportunities. But you would think that there is some convergence over time. So when you think about shale coming to the rest of the world, is this happening in the next 5 years, next 10 years, in the next 20 years? Never. Does it just come from North America and Australia and other areas where natural gas is prevalent and is proven? Or do China, do Poland, do Argentina, do the UK end up producing some degree of natural gas and contributing over time? So the shale gas opportunity in the US is quite large, and the $640 billion investment, a lot of the stuff on the right side of the pie chart, pipelines, pumps, gathering lines, gas processing, you've heard a lot about that. But one of the key components is this lease equipment, 200+ million. That's supply chain management as you try to focus on the greenfield construction associated with this infrastructure. And you say, well, why does this make sense? Why is infrastructure so an important part of this? Well, for the US, you might think of it in terms of the US trade deficit and this opportunity to invest. Right now, this potential $200 billion that could be invested in the Gulf Coast represents an opportunity to take advantage of the global discount for which the US hydrocarbons is selling in the global market. We estimated it probably 25 to 30%. So you invest in the infrastructure to take advantage of that arbitrage and close that gap. So you might think about what are the returns for that, what are the impacts for that. In the Gulf Coast alone, there might be $200 billion through the balance of the decade going in. Massive opportunity. Petrochemical facilities, fertilizer facilities, LNG facilities, export facilities for ethanes, ethylenes, polyethylenes, and then also pipelines. The US is exporting gas and other hydrocarbons by pipeline. to Mexico as Mexico continues its industrialization, and then also to Canada. So that reversal of flow is somewhat dynamic and somewhat unique. But it also creates a ton of jobs. In the Gulf Coast alone, we're estimating 100,000 new jobs through the balance of the decade. So that skilled labor component needs to come from somewhere, and it'll start to cannibalize some other parts of the industries, but maybe a great opportunity as well. So how do you view the risk profile of investment in U.S. energy? I think we're midstream in the presentation now. You can start to gauge it, and you know, low, medium, high. Well, let's just take this chart, which again shows the U.S. geography, gives some indications of a lot of arrows and a lot of gas flowing around. But what I want to do is give you a couple examples where those dynamics have changed quite rapidly in the last 5 years. So what we've seen, and this goes back to the wet gas versus dry gas characterization I talked about earlier, there was a lot of focus on wet gas production. Just any kind of natural gas that had liquids seemed pretty attractive. But then the global price of oil dropped off significantly, and it was kind of lost. And then there was a race into the Haynesville Shale, and the Haynesville Shale is eastern part of Texas and the western part of Louisiana. There was a land rush. People were paying $30,000 an acre for resources there. So 3 years ago, there were 300 rigs running there. Today, there's only 3. As the hydrocarbon economics changed and the price of oil went to $100, you had people focused on the liquids basin. And there's a limited amount of money, people, and equipment, rigs, in the US today. And as a result, that money, people, and rigs moved to the basins where the economics, were compelling around liquids. That was a stranded investment. Fast forward, there's just been a private equity investment in a contrarian play around the opportunities in wet gas in the long term versus this dry gas in Haynesville Shale. So the dry gas opportunity may fill in for the supply inadequacies of the wet gas as we look forward to the next decade. So traditional PE play, but what's the return expected from that kind of equation when you're taking advantage of some potentially stranded investment in midstream in the past, and again, buying at a discount to what the replacement cost might be. Another quick example is, you might have heard about the Rockies Express. So the Rockies Express was a massive, federally regulated pipeline that went from the Rockies Mountains, where gas was very cheap to produce but couldn't attach to demand, all the way to the eastern part of Ohio, right at the point where demand was really taking off in the northeast part of the US. That was started about 7 years ago, and as a result, the pipeline was built, they signed up tenants. Federal regulated pipelines have a great component. It has a monopolistic element to it, but it still depends on volumes. And the volumes are the denominator in the equation of rate making in the US and other parts of the world. What we found, however, is the Marcellus Shale. So go back a couple pages, that big, dark pink line at the eastern edge of Pennsylvania, eastern edge of Ohio, all the way up into Pennsylvania, into New York, and into the Northeast. The Marcellus Shale has been the most prolific find in the US hydrocarbon basin in quite some time, totally obviating the need to move gas from the Rockies to the east, and resulting in about a 50% loss in value for that long-haul pipeline, despite being regulated. So everyone would have said that's a core investment, that's very safe, that's a utility investment, but here we have the hydrocarbon basin economics changing all that. Now, private equity group, again, contrarian play, went and bought that pipe, worked with the federal regulators for 3 years to reverse the flows on that pipe, and now the hydrocarbons are flowing east to west, out the Rockies, out into California, and potentially for export to Asia. So again, just give you a sense for how things have changed and turned upside down by some of the dynamics that we're seeing. And lastly, keep in mind this thing in the upper right-hand part of the chart here, the table, the picture, Sable Island gas. In Nova Scotia, off the coast of Nova Scotia, this Sable Island, we're producing a lot of wet gas. Built a massive pipeline through the state of Maine, where I grew up, and I'll tell you about an investment we're making there, into Boston and into the Northeast. Gas was flowing, seems great, but now that gas is out of favor. That pipe is in the process of being reversed for an export facility to Europe, again, as Europe looks to shore up their security of energy supplies as well. So a lot of changing economics affects midstream, not just upstream, and let's keep that in mind as we go forward and think about the risks. So I think we covered some of the risks of the equation. We've got regulatory risks, we've got inflationary risk. Do you have contractual frameworks to pass through the cost of inflation of either construction and or fixed cost? Construction risk, some pipelines take a very long time to construct, some are relatively short. LNG facilities might be 5 years, a very complex construction, but you have very long-term contracts to support that. I already mentioned production, volume composition, very important to the overall economics and how you think about return expectations. Recontracting risk and market access. You're building 50-year assets here, but the contracts, even the longest contracts, may only be 15 or 20 years. So what's the commercial opportunity going forward? How you optimize that and how you can predict that? As Dino talked about earlier, forecasting is a very difficult science or an art or some combination thereof. But at the same time, a lot of these investments have a way of finding new application and attaching to demand. So what I mean by attaching to demand is finding ways to get local demand or overseas demand for the products you're selling. Local demand's the easiest, right? Power generation, natural gas substituting for coal or other forms of inefficient oil production of electricity, that's a natural. It may take some time to build out the supply stack, but that's a huge opportunity. Heating. Space heating for commercial applications or residential applications, that's a huge opportunity. I already mentioned petrochemical investments, fertilizer investments, exports of LNG, liquefied propane, ethanes, ethylenes, et cetera. Transportation and trucking across the US. If you got gas-fired trucks out there, the payback is a very short period of time, but there's fundamental confusion about the logistics of refueling as you go cross country that I think can be remedied here as people think about that more carefully. Locomotives, vessels, barges, and then personal transportation is the holy grail for attaching to some of the demand here. Let me just give a quick, sorry, before you jump into that. So which segment, based on some of this information I've provided, do you now think is the most risky? Is it upstream, exploration, production, where there's a lot of data, midstream? Given some of the examples I showed you, it might be stranded in some scenarios, or downstream, where you're close to the customer. I want to just give a quick pictorial, because we've been jumping around a little bit, on how does this value chain really work and thinking about where you might be able to play as an investor. So the production derrick on the left side of the page gives you a sense of what you can produce in terms of hydrocarbons, natural gas and oil, just to keep very broad categories. The natural gas value chain is at the top half of the page here, and oil is at the bottom half. And we've left off a lot of the demand side equations. We left off the huge power demand, et cetera. But you see a lot of convergence across that part of the segment. But it starts with extraction of hydrocarbons, gathering systems, logistics around gas processing and separation of natural gas from the mixed natural gas liquids I mentioned earlier, fractionation of one, storage of the other, and then a derivation of other exportable products or products that we appropriate for feedstocks into other industries, ethanes, propanes, butanes, et cetera. There's a couple different ways to play, and if you're thinking about core, the pipelines make a lot of sense, storage makes a lot of sense. Anytime where you can have a long-term commercial contract around very stable demand. I think we'll come back to that in a minute. On the oil side of things, you've got trucks, you've got barges, you've got rail. There's a lot of ways to move those things. One of the things I should have pointed out earlier is that at the northern part of the US, against the Canadian border, there's also a light oil shale revolution in something called the Bakken. There's a massive amount of investment in North Dakota, which is producing crude oil, which is then brought by truck, brought by rail, and brought by pipeline down to the Gulf Coast, where there's a lot of refining capacity in the US. One of the interesting fun facts is, due to the viscosity of oil flowing in a pipeline, if you take a train of 100 tanker cars, and that's called a unit train, that unit train can bring twice as much oil as the pipeline can in the same amount of time. So these rolling pipelines are actually more efficient. Now that's led to infrastructure constraints because other things like to move on rails in the US, and it's hard to build new rail. So coal, which I already said is being disadvantaged by natural gas for power generation, is also getting pushed off the rail and delivered coal is probably 80% transportation costs and 20% commodity costs, so even further disadvantages coal for power generation for other applications. So outside of the metallurgical coal, which is exported, you have a lot of people competing for these resources. So these bottlenecks in infrastructure have large implications for investment, but how do you get at it and how do you play it? Let me give you a few quick examples. One way to play it is gathering pipelines. And that's at the more risky side of the equation. Gathering pipelines are close to the hydrocarbon production basins. You've got contracts that are relatively short term. You're working with producers, some of which are non-investment grade, and you're financing with high yield debt. So the returns there should be 15 to 20% or better. You're taking a lot of risk over short-term contracts and based on commodity-oriented fundamentals. Now, at the long-distance pipeline, if you put aside the Rockies Express example I gave earlier, these tend to be fixed-fee long-term contracts, regulated, investment-grade financing, and therefore maybe fall more into the utility category of kind of 8 to 12% returns. So just a couple examples to think about it, but there are short-term and long-term opportunities to play in that space. So again, as you think about energy and you think about your broader portfolio, what are the kinds of returns you would expect on that? And I won't dwell on this, but we can kind of come back and think about it as you digest some of the things we're talking about today. Obviously, a lot of capital raised. I mentioned the $50 billion raised. A lot of that money is for opportunistic production and services, in contrast to core, which are maybe pipelines, terminals, distribution. Anytime you have long-term contracts and long-term fundamentals or history where you can sign up a long-term contract and have investment-grade financing. So in my mind, core may be an 8 to 12% return. Value added, which is gathering and processing, that might be kind of 15 to 20%. And opportunistic are very high risk, very high return opportunities where you're less focused on the IRRs and you're really focused on more traditional PE multiples of invested capital. So maybe 3 times or more when you're talking about production of hydrocarbons in the US. So there's another way to play the natural gas shale revolution in the US, and that's at the utility side of the equation. That's at the natural gas distribution side, where it's used for some industrial, a lot of commercial space heating, but also residential heating. So this is an example of a portfolio company we have in our Developed Markets Fund, which in Colorado and Missouri, natural gas substituted for propane as a heating fuel in residential communities. So behind that management team that had done it in 2 prior states, we looked to expand in the state of Maine, where that pipeline was running through, but no one in Maine was getting access to natural gas. So you said, well, there's gas there. People are burning home heating oil in their homes. On paper, it seems like $1,500 of savings for every heating season, basically cutting people's bills in half. How can we access this? What are the kinds of business plans we need to put in place? So our management team went out, worked with the key stakeholders, spent 24 months aligning them around politics, regulation, labor. Maine's not a state that has a lot of labor. We need to bring labor on board to complete this build out. Community engagement, education, is natural gas safe, and really to make that potential economics real and sustainable. So what we did is we went in, we set up a phased in approach where over the next 7 years, we started 2 years ago, and for 5 years to go, you can spend almost $1 billion investing around natural gas in a very fundamental way, in a regulated utility model where you don't have any risk and you don't have any competition. It sounds too good to be true, but it's interesting that here in the US, where a small state of Maine, where there's only 1 million people and not very densely populated, you can have $1 billion opportunity. So that's maybe half debt and half equity with traditional utility rate making in this particular state. So with that in mind, it's all about alignment of interests. So you have an opportunity to build out this system, but you need to get a lot of things done and put in place up front. You need to have an environment that's very receptive to private capital and making sure that people are all focused on the long term and it is truly sustainable. A diversified customer base makes sense. You have to have some additional benefits. We created 700 new jobs. And then as a follow-on opportunity, energy services through the life of these pipelines, which may be 50 or 100 years as we look forward, there's probably an equal number of new jobs around services around boiler, conversion, burner tip change out in people's homes, and then the maintenance and servicing of those going forward. And this is, good targeted returns, 12 to 13%. So I think one of the fundamental things is if you get close to customer demand, you work back from that demand, that creates a very sustainable model. And in doing so, it also emphasizes a very important part of infrastructure, which is being local, being connected locally, it leads to opportunities, and you all know that your best opportunities are based on something where you already know an opportunity exists, you can build on something you're already doing. That's what we've done here. A lot of you have done that's what we've done here in the US. A lot of you folks in the room have done it here in Australia, and you're finding other opportunities to do it abroad.